time will tell, in the sense that it is a very throughout restructuring. They've been listening to the market, and the equity market has been telling them to undergo this very deep restructuring and cutting of both the geographical and the product footprint of the bank. Of course, considering where the share price of the bank is lagging, it was very difficult to, on top of those restructuring costs, impose a capital raise. So we'll see whether the management is able to achieve this return on tangible equity by 8% in 2022. But it is a very deep restructuring, much more than the previous ones announced, I believe, 2.5 years ago.
We are anticipating a quarterly loss, a second quarter loss of 2.8 billion euros. Those numbers will be out in a few weeks' time from now. When do you think that things will turn around and we'll see these restructuring changes start to bear fruit in terms of profitability coming through at the bank?
I think also in terms of the profitability coming through, you need to look at the second half, probably of 2020, even in 2021. I think also the most important part will be on capital, because the bank is lowering the CET1 target down to 12.5%. They implying that the regulator, they're sort of okay with that, and I think also we'll need to see whether the regulator will give the management the benefit of doubt, because of course also if it's not the case, then also the risk is that Deutsche Bank may have to raise capital next year. But I think also for the profitability, we need to wait probably another year or so. Yeah.
Okay, what's the biggest issue you think facing European banks at this particular moment in time? And are you anticipating any of the other big names to have to embark on a restructure similar to what Deutsche Bank has announced? And if so, who?
Yeah, well, so Deutsche Bank in that sense is very unique, because probably that's so they're coming a little late. What other banks, if you think also the likes of UBS, so the likes to some extent of Credit Suisse, what also BNP Paribas has done in the past. The other banks, so Société Générale spring to mind. So they trying to say increase the capital while not penalize too much an already very subdued profitability. I think profitability is an issue for the European banking sector. That's from Germany to Spain through Italy, and I think also all the banks management, considering the shape of the yield curve in Europe and the fact it is very negative in the short term of this curve, and so they're resorting to essentially cost management. I think also the cost to income ratio is still too high in Europe. On average, we're talking 75–80%, which also considering the fact that also the revenue side of the business is constrained, because also Europe is growing, the European growth is very subdued, and I think also unfortunately the only lever left to the management of the European banks is cut costs and invest in the digital economy and trying to make those institutions more linear. I think it takes time, but the direction of travel is pretty clear.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.